Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We're diving right into one of the most drastic corporate transformations we've seen in the small-cap biotech space this year, the sudden pivot of VYNE Therapeutics from a failed dermatology developer into, well, an acquisition vehicle for Yarrow Bioscience, Inc.
And the market reaction to this whole maneuver is just fascinating, mostly because the company's history makes this outcome so painful.
It really is. Our focus today is on the price action right after that December 17th merger announcement, where the stock just settled, consistently in that tight range of 38 to 40 cents. And the central disagreement for us is this. Does this very low, very narrow price represent an efficient, rational calculation of a special situation arbitrage, or is this price just the final ugly sum of VYNE's catastrophic corporate failure?
I'm arguing that focusing only on the efficiency of that final number, that 38 cents, is to completely ignore the context that drove the stock into this abyss in the first place. That price, it masks a comprehensive corporate failure.
And I'm going to hold that this price is demonstrably efficient. It's anchored by precise merger math. The market, in this case, treated VYNE exactly as it should, as a cash substitute plus maybe a long shot call option on a new asset. The calculation it's nearly perfect. All right, let's start with the hard numbers that anchor my position. The current trading price, I think, confirms the market's ability to price these special situations with remarkable accuracy. The price floor was set directly by the terms of the merger, an estimated pre-closing cash dividend, targeted at somewhere between $14.5 and $16.5 million. The market saw that floor immediately.
A floor which is devastatingly low compared to where the stock was even a year ago, but go on.
Well, sure, but taking the midpoint of that dividend range, let's say $15.5 million, you have to establish the denominator, the fully diluted share count. And this includes the 19.8 million common shares, but crucially, it also includes 23 million pre-funded warrants. So that gives you a total of 42.8 million equivalents. You divide the cash pool by that diluted share count, you land squarely at about 36 cents per share. The market trading at 38 to 40 cents just means it priced the cash dividend at 36, and then assign a nominal 2 to 4 cents for the remaining 3% equity stub in the new Yarrow entity. This isn't arbitrary, it's textbook arbitrage.
Okay, that math is technically sound, I'll give you that. But to focus on the dividend calculation is to ignore the colossal corporate failure that required this merger. The stock price got to this pitiful 38-cent level because the company's entire reason for being, its pipeline, completely imploded. The main cause was the catastrophic failure of the Phase 2b trial for reprobacib gel for vitiligo. That was back in July of 2025. And this wasn't a minor setback. The drug failed to meet its primary endpoint, the FVSI 50.
And for our audience, the FVSI 50 is a pretty standard measure in vitiligo trials. It's basically looking for a 50% improvement. It's the benchmark.
Exactly, and the failure was blamed on an unusually high vehicle effect. This means the inactive gel, the base itself, performed almost as well as the drug, which just wiped out any statistical difference. That news led to a 74% single-day crash. And for any long-term shareholder, that 38-cent price is the final brutal cut after they've already endured a cumulative 1 for 72 reverse stock split history, a 1 for 4 in 2021, and then a 1 for 18 in 2023. These splits mathematically crush their cost basis, turning that final 3% equity stake into a token of abandonment, not value.
I appreciate the focus on the historical pain. I do. But we need to distinguish between the failure that causes an event and the efficiency of the market pricing the event. Let's stick to the numbers driving the payout. You emphasized the reverse split, but the critical dilution factor in this dividend calculation is the 23 million pre-funded warrants.
And what's the functional difference? To the long-term holder, all dilution is just economic loss.
The difference is transparency, it's fairness in this specific framework. The dilution from those warrants is purely mathematical and it's highly transparent. These pre-funded warrants, they function as equity equivalents. They represent capital that was already committed and paid for. So they have to be factored into the 42.8 million total share count If they weren't, you'd be creating massive value leakage, just unfairly enriching common shareholders at the expense of warrant holders. This just shows the rational risk pricing mechanism working exactly as intended.
I understand the technical necessity. I get it. But that clinical approach ignores the root cause here. The psychological and, the economic impact on the average long-term holder is tied to the history of those reverse splits. Those splits were driven by compliance needs, specifically NASDAQ minimum bid price rules, after repeated failures. They weren't voluntary corporate actions. They were moves to avoid getting delisted. And we can't just focus on the Ripaceb crash. Earlier in 2025, back in April, the company had a clinical hold on VYNE 2022, an oral BET inhibitor, because of testicular toxicity signals in dogs. So you have this sequence of failures, the toxicity hold, then the catastrophic Ripaceb failure, that created a shareholder death spiral. The cumulative 1-for-72 ratio symbolizes management's total inability to deliver, and that 3% equity stub is just a consolation prize after a 93.5% loss.
But you're describing the failure of the investment thesis of the old company. My point is that the market is acutely focused on the thesis of the new company, and that shift is priced efficiently.
Well, that brings us to how the market actually sees that price. This focus on sophisticated arbitrage completely ignores the emotional, the speculative element of the market, which is so volatile in these little biotechs. The noise, especially from retail sentiment you see on forums, it shows this deep, enduring distrust of management. They're focused on speculative things, like hoping for gap fills to, $1.50 or $2, totally ignoring the risk. The 3% outcome basically confirms the suspicion many retail investors held, that management's use of things like reverse splits was just a way to rob them. The 38-cent price validates their narrative of being victimized, not the arbitrager's narrative of efficiency.
I'm not convinced by that line of reasoning because you're confusing the noise floor with the signal. The professional market, institutional capital, it provided a very clear signal that this was coming. We can see this in the market microstructure, specifically the off-exchange activity. On December 2nd, 2025, we saw this highly anomalous spike in the off-exchange short volume ratio. It hit 78.65%. To put that in context, the typical range is 30 to 40%. A spike to nearly 80% it's extremely significant.
Okay, and what does that short activity actually tell us?
It tells us that professional desks were aggressively positioning for the arbitrage opportunity. They weren't just naked speculating. They were executing block trades in dark pools away from the lit exchange to build up big positions and, crucially, using short hedges to manage the risk. When you have institutions positioning to buy millions of shares because they expect a cash dividend, they often hedge that risk with massive short positions off exchange. It lets them lock in the spread. A 78% off-exchange short volume ratio isn't retail pessimism. It's a highly sophisticated trading signal, confirming that informed capital had already modeled the 36-cent floor. That is the definition of market efficiency.
I see the point, but let me offer a different take. Even if they positioned efficiently, they were positioning to buy a burning wreck. They were buying the right to clean up a mess. I'm sorry, I just don't buy that the quality of the new asset completely overrides the wreckage of the old. The price is depressed because of the high binary risk in small-cap biotech, a risk VYNE embodied perfectly. The new asset, YB101, a TSHR antibody for Graves' disease, sure, it's an exciting mechanism, but it's still entering a brutal and competitive landscape dominated by assets like Tepezza. The prior failures of VYNE, the toxicity, the Ripaceb failure, the reverse splits, they remove any safety net. When you buy this stock now, you're buying a company with zero margin for error, and the market is reflecting that.
Respectfully, the entire investment thesis shifted on December 17th. We are no longer talking about Ripaceb or VYN202. The quality and, frankly, the potential of the new entity, Yarrow Bioscience, completely overrides the failure of the old VYNE pipeline. And the ultimate validation isn't the dividend calculation or the short volume. It's the massive $200 million pipe financing that came with the merger. This funding came from elite dedicated life sciences investors, RTW Investments, OrbiMed, and Perceptive Advisors.
And what does a name on a check prove?
It proves that highly specialized smart money has done extensive scientific and commercial due diligence on YB101 that the average investor just can't replicate. These funds are not gambling. They are providing the ultimate scientific validation. I mean, think about the implications. $200 million provides a capital runway into 2028 that insulates Yarrow from market volatility. And the selection of YB101 is strategic. It targets the TSHR, which is seen as the root cause of Graves' disease. This is potentially a more direct and safer approach than Tepeza's target.
That's a compelling point, but while the TSHR target might be more appealing scientifically, Tepeza has established efficacy, it has market share, and physician comfort. Yarrow still has to prove itself, and it has to do so while wearing the historical baggage of a 1-for-72 diluted legacy entity.
But that is exactly why the price is efficient. The 36-cent dividend covers the cost of cleaning up the past. It effectively removes the wreckage. The 2 to 4 cents remaining is the market pricing that 3% stub, which is essentially a free option on YB101, validated and funded by $200 million from the most sophisticated funds in the sector. You get your cash back, and your new investment is capitalized for 3 years by experts.
You are asking long-term shareholders to feel comforted that their investment, after years of clinical failure, ended up being used as a cash box for institutions to launch a new, highly speculative venture. The pipe confirms one thing: the old VYNE pipeline was worthless, and this merger was the only way out. The 38-cent price is the price of the cleanup, not the price of success.
So, to summarize my position, the trading price of 38 cents is a clear reflection of the market performing a highly sophisticated arbitrage calculation. The price is meticulously set by the 36-cent per share special cash dividend, measured across the fully diluted share count, including those warrants. All the market microstructure signals, the huge off-exchange short volume, the narrow trading range, they confirm that institutional capital efficiently priced this transition. The focus must now shift entirely to the new, strongly capitalized Yarrow entity. The market is efficiently looking forward.
And I'll just reaffirm that, Mom, the current price may represent a technical, mathematically derived floor for arbitrageurs. The enduring narrative for this stock remains defined by catastrophic corporate failure. The pain is centered on that cumulative 1-for-72 shareholder dilution and the crushing clinical disappointments of July 2025. The current price is simply the cost of management engineering a soft landing out of total necessity, not some measure of market triumph.
Ultimately, this situation really requires investors to distinguish carefully between the mathematical certainty of the dividend arbitrage and the powerful, painful legacy of small-cap biotech failure. The path forward for the combined Yarrow entity and whether that institutional validation can overcome these historical failures, well, that remains the critical subject for continuous analysis within our source material.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.